everyone. This is another episode of our Roundtable with Damp Spring. We have Jimmy Jude and Nik Lentz here. My partners, they operate the Damp Spring MMA, DSMMA, as well as help me with, Jimmy in particular, help me with Damp Spring. What we do here is every month we come together and talk about the bigger themes, less so what's happening next week, but more what's on our mind and what we're thinking about for our investments, both our long only beta investments and our market timing. So I'll start and tell you what's the topics that are on my mind, and maybe we'll just talk about any other topics you guys are thinking about. The thing that I'm focused on, I think the world is focused on, is obviously the AI, both the potential for it to be its own source of revenue and returns, and its implication on the rest of the economy, and its funding. That's what's mostly on my mind, but also what the consumer is doing and how their circumstances are changing, including in the face of AI. I think you have to talk about the bond market nowadays because bond markets are trading differently than they have, and it's been a long bear market for bonds that doesn't seem to be going away. I don't love talking about politics, but the election is in front of us, so perhaps some comments on, how we think that plays out. But those are the topics on my mind. Do you guys have any topics?
No, I think that's good. I think that covers. We can take that so many directions. So I think that's perfect.
Great. So, Nik, do you want to start us off? What are you thinking about? I think, it's always useful to just put our long-term investing philosophy and our market timing in perspective. For me, at the moment, I'm pretty neutral. I like owning a diverse portfolio of stocks and bonds. I don't think the forward-looking returns are great for them, but I own them because you always want to own that sort of stuff. And from a market timing situation, I think there's some opportunities, but nothing is pounding the table for me. How about you, Nik?
Well, it's interesting because I think everybody sort of understands this circular funding nature can't last forever. That these type of earnings in these companies, it's just not something that you can comp out 5 years from now. You can't comp this type of growth. It's just unnatural, and it's something that is it can't last, right? But when we look at this earnings season, you see that the companies are still making money. They're still projecting it far into the future. So it makes it difficult to sort of not expect that to continue until we actually see the earnings start to pull back.
And right, and that's sort of a drift that causes things to go up.
It causes everything to go up. And then we get these scares where people are like, oh, software is going to go to hell because it's going to be replaced. Then it doesn't be replaced. Then we have another factor that drags the market up. And we have this rotation that keeps the ES flat enough that it keeps we have these mini pullbacks and then it gets bought. We have these mini pullbacks and it gets bought. And so our trading method and just my trading method in general over the last few years has just been to kind of sit back, wait for these dips and buy the dips and then scale out of it, and it's given us a good opportunity to do that. So in the long run, I do not think that these type of earnings, this type of growth can last. I really don't. But in the short term, until that data changes, I don't see it affecting the stock market except for the positive in the short term. Now, when you bring up the bond market, is a little more forward-looking. And as we can see with how high real rates are, we can see just bond prices in general. I mean, you can't get a rally to save your life in these things. You know what I mean? Like we have cool inflation numbers. Then we have the weak jobs report. Then we have another cool inflation. Then people are like, oh, well, we got to confirm it with the PPI. We look at the PCE feed-through metrics, and all of it points to it's not tame. It's obviously above expectations, but it moves September off the board. So you would think you would get a rally in duration, but it's struggling. Like reels are not cracking down. So I really believe that there are sectors that are great to buy. I liked buying software. We bought a ton of software names and they've done really well, but I wouldn't chase it here. I like just the idea that you need those pullbacks on geopolitical stuff. For example, you brought up the election. Most people lose money when they worry about politics because they let their bias get in the way. But this is a time where we could get disjointed price action based on who's going to win or whatever, what direction that goes into. We could get, you could get a crypto pop if people think Trump is going to win. If you could get, like an insider trading style with the Intel popping or crashing or whatever. There's lots of things you can do into it. But in general, can this type of growth last? Absolutely not. Can the market just go up forever? Absolutely not. But I don't see in the current data with this earnings season behind us a sustained bear market or at the end of this, whatever you want to call it, whether you want to call it a bubble, you want to call it a whatever, right? I don't think that it's over yet. And I think that we need to see that turn in the data before we really start to talk about the death of this exuberance. Because until the earnings change, I don't think that the equity people are going to change their mind. The bond market, definitely. They could definitely front run it, but I just don't see it in the equities.
What about you, Jimmy?
I'm not a pro on this subject by any means, but by reading and paying attention to it, I keep hearing the same thing, that we're in the early innings. There's still a lot of build out to go. So to expect it to, waver now, I think we're probably a little early, because there is, we have all these plans. But we also saw, the hyperscalers, when they reported in Q2, kind of say, like, instead of like this capex spend being like an absolute, it was to be determined. We may spend this. So those little question marks, those are going to keep it a bumpy ride higher. I thought this week, I thought a lot of the charts that pulled back hard in June, like the memory charts, and there were some of the hyperscalers like Oracle pulled back hard too, but I thought they made some really solid moves off their lows, and they really repaired their charts, and their charts are looking healthier and healthier. So I don't, where I did see a technical, mini crash and mini scare there, I'm starting to see that come back. So that's, like Nik said, that's kind of raising all the boats, because that was kind of the one scary piece of the market. Everything else was trading relatively well. Small caps, the equal weight was trading well. It was just the mini scare in SaaS, and I guess it was a funding scare that caused Oracle to drop. So there are speed bumps out there for all these plans.
And it's not just a scare, it's the truth, right? Like Oracle's balance sheet is ridiculous. They have so much debt. We bought it. Like I bought Oracle at the lows. But I sold it because it's just like there are better companies to own, but like that this funding, it can't last forever. And once it turns, you're going to get one of those NASDAQ-like scenarios where you buy the dip and you better be quick, because it's going to keep dipping, It's just, it's insanely hard to time that.
Yeah.
And I don't know if it's even possible, because if by definition a bubble or whatever is a euphoric nature, it's not going to change if the PE goes from 21 to 21.2 or 30. Like, people aren't using these metrics. They're using feelings. They're using, and we don't know what's going to, the thing about the future is it's hard to predict the future. So we don't know if it's going to work, right? It could very well be this big productivity boom, or it could be make-believe nonsense, right? Like, I'm one of the biggest AI bulls early, and I routinely find myself constantly arguing with people online about AI's lack of ability. Like, I'm the bull, and people are yelling at me, telling me I'm degrading it just because I say it can't replace Salesforce. It can't replace Adobe. Like, it just can't. Like that's not what it does. It's a productivity enhancer, but it's certainly not going to lead to these doom scenarios where, nobody has a job and they can't do anything and money doesn't exist anymore. Like that's pretty far in the future. And
Yeah, I
so
mean, I think that's the big thing, which is there are some extrapolations of doom and utopia that are not really that productive. Okay, that may happen. Either of those two things may happen, but can we invest based on that? So when I think of the dynamic on AI, for me it comes down to a fairly practical thing. AI models are rapidly improving. Rapidly improving. You just can't look at an AI model and say what it was able to accomplish in less than 3 years ago is anything like what it can do today. And it's infiltrating us in ways that are like, this is one of those things where, like, once everyone had AOL, everyone could grasp the internet. LLMs have democratized that as well. And so everybody now can see, some good, some bad, the influences of AI content creation across just about everything. And fact checking across whenever anybody puts out any piece of information, the fact checking one can do is, it's made massive progress. But what you don't see, and it's because that's where the real money is at, what you don't see is the power it has created, not as a chatbot, but as what they call inference, which is specifically designed for a particular application and trained within that application. And whether it's systemizing markets, which is a tricky problem that we've been doing for all our lives, and these tools help that, or improving logistics for Amazon, or search for Google, or advertising, targeting advertising for social. All those things are improving significantly. And so I think you have to say, wow, that's a big change. And it could have marginal impacts, not doom and utopia, but marginal impacts. And so when I think about it, I think about those marginal impacts. But with that said, that AI is a massive, massive change that is moving rapidly, there are other things that are going on. There's regulatory. How will the government interact with this thing? Most people are, and I mean, when I say that, voters, are panicked about what AI could do to them. They don't like it. Ask your youngins. Mine are early in the workforce. They hate it. They think it's awful. And certainly it's going to have some challenges as it infiltrates our life more and more. But that's, again, marginal. The thing that's in front of us, that's literally right in front of us, is for it to achieve its potential, for the companies that are in the space to achieve their expected returns, to grow into their prices, to earn the earnings that are being forecast by consensus. A tremendous amount of capex has to be spent. And it's not just capex from cash flow anymore, it's capex from issuance. And our estimates are that there'll be $1 trillion of marginal cap issuance by the private sector this year. In 2027. That is a headwind. It's a headwind for every asset. It's a drag on people's savings, cash. It competes with all the other things they own. other stocks, other companies' stocks, their municipal bonds, their treasury bonds, everything they own, their homes. Everybody is going to need to absorb $1 trillion of issuance. Now that's fine. If that issuance pays off, it'll self-finance in a few years. But right now, what's in front of us is this massive wave of asset selling, and which is a headwind on assets, but also a massive tailwind on the economy. When I say that, hey, you issue $1 trillion of stuff and you spend it on stuff, the spending on stuff pushes the economy up. And we're seeing that in the data. Capex spending is, along with consumption for now, is the strongest part of the economy, and torrentially strong, just on fire strong. And I don't expect that to change, but at the same time, it does influence, it comes at a headwind for asset prices. Unfortunately, so when you look at that and say, well, asset prices have all this supply that needs to be funded, and the economy is going to grow like weeds, very short term, that tells you the bond market's fucked. Because the economy growing like weeds is bad for bonds, and assets being under pressure is bad for bonds. While stocks, a lot of selling, but also great economy is less bad for stocks. And so for me, when I think about all of this and what's priced in, it's certainly not favorable for bonds. And so that, to me, is the big trick about buying bonds. That said, from a pricing standpoint, bonds are as cheap as they've been in a while, and stocks are as rich as they've been in a while. Because what those expectations are built in. And so I think we have a pretty big headwind on issuance. And so I just wanted to finish this with, how does this usually work? How does issuance usually work? Pretty much every time there is a euphoric future expectations for growth, markets rise, real economy participants sell into that to raise money to make that investment. And at some point, and what that point is really the timing question, at some point the capital markets say, I can't take anymore. And they don't just slow their buying, they stop. The issuance world, the capital markets close to new issuance. I think that point's coming. I think that point's coming in the next year. And if it does come, that means the capex machine slows. And that's when you get the double whammy on stocks. When it happens, that's a good question. You know, I look at various catalysts, and so far, the economy has absorbed, the markets have absorbed the issuance. Now it's small relative to what's coming, but not insignificant. Google, I think it's basically at the price it did its $80 billion issuance. SpaceX, challenging after its IPO. It's not ripping, it's about where it did. You're not getting the investors who are buying new issuance in the corporate bond market are choking on it. Every new corporate bond issuance results in higher corporate bond yields across the entire sector. Okay, so it's being absorbed, but not pleasantly. There's been some concessions going on. And so for me, the question is, does the greatness of AI deliver quick enough so that the capital markets never close to issuance? Because if it doesn't, you're going to have a big bump. And I think you're going to have a big bump.
Where will that originate, that bump? Where do you see it originating? In an actual, like an individual company issuance, having an issue with that, or will it come from treasuries first? Will the,
That's a good question. It's going to pressure all those things. You know, it's, you know,
like, will there be like a moment where it'll be absolute,
I think
be
there will
definitive?
be.
Yeah.
I think there will be. And I think it'll be some sort of, hey, this deal went badly and stayed bad relatively quickly.
Hmm.
But I'm not sure that's it. That may not actually be the specific top of the stock market, for instance,
I think the
because the
sign.
earnings are still going to come, even though the capital markets may start closing down. So I think that's going to have to do with, at some level, positioning. If positioning is over levered when that happens, then you could have an immediate cathartic thing that never recovers, like a real sort of island top or whatever they call that thing
Yeah.
on the with the candles. But you could have, hey, this deal didn't get done very well. The next deal people are hesitating on,
Hmm.
but the earnings are still so good. We're going to extend it for a few months, and then you have
Yeah.
your event.
I think it'll be
Again,
similar
I'm not
to
sure.
we just did the situational awareness thing, which is a small fun, but like it'll be when something like that happens and then the next one happens. It's not, it like won't be an insular thing. So you start stacking a few of these things together. So you get a situational awareness, except in the bond market, but just if you picture it the same, you get a situational awareness. Then it's like, oh, they didn't buy it. Citadel didn't come in and buy it. Then the next one, oh, this one came, and they're like
Right. I
that.
like to think of that like, so in 2007, in the summer of 2007, you had so by February of 2007, everyone knew the GFC was coming, or at least subprime was dead. And then you had a pretty cathartic summer of 2007. You had a bunch of stat arbs blow up. You had some M&A deals blow up. You had a mortgage hedge fund blow up. And that was a canary in the coal mine, but it didn't say the mine was exploding the next month. In fact, throughout the year 2000, late 2007, early 2008, things went pretty well. Even up till Lehman, things went pretty well. And so I could imagine, it's one of those things, and maybe situational awareness is a one-off, and nobody like that. My read is everybody's like situational awareness, and almost no one, and only one was so big that it got taken out. That there, but for the grace of God, go I sort of thing was felt by many. But I could be wrong. It could be a complete one-off, but it feels like more like summer of 2007 than it did that in the situational awareness thing. That yes, something's really in trouble. That this is gonna happen, but not today.
Yeah, I just think the market and just the human nature is to look past things until you're forced not to. We had I always mess up the acronym, but what it was, so SVB, what was the bank that blew up? The
Silicon Valley Bank, SVB.
Yeah, SVB blows up, and then everyone's like, oh crap, and then nothing happens. That like that's the what do you call it? That's sort of the script right now. It's just going to be a one-off, but
Well, let me
eventually
ask
it
you a
won't
question
be a
on-
one-off. Go
Let
ahead.
me ask a question on that. So when I think of SVB, I think of it was I used the term at the time, tempest in a teacup. That there was SVB, there was First Republic Bank, there was a couple of other banks, but everybody else was pretty much okay. And I think this is the important and the policy response was over the fucking top. If you remember, what the hell was the acronym at the time? Anyway, the program where they basically let you lend 80 cents on the dollar of collateral. God, how do I not remember that acronym anymore? It was like BTFD.
Yeah, that's what I remember now. Yeah, but none of us know. We're gonna have to cut this part from the
BTFD
video.
that I would confuse it with BTFT, which is what you should have done when they announced that thing.
Exactly.
So I guess the question is, and this does come into, sort of what I'm thinking on policymakers. Are policymakers going to prevent it? Is the AI war, and I think we're being sold a bill of goods. China has lots of issues, and I know they're competing, and there are lots of them, and they have reserves, etc. But China's not like some monolith spectacular economy that can crush us in the AI war. But we're being told we're at war and we're on a war footing. And of course, all of the self-interested AI providers are pounding the table. This is a war, we've got to win. It's existential. Would the policymakers just jump in? And if so, what does that mean for the dollar, for bonds?
Yeah.
And I don't know. The room, like the room for policymaker action, to me is as thin as I've ever seen it. Like, how can you justify a policy response that is inflationary and stimulative with asset markets where they are?
I guess it matters what I guess it matters what you think. Like I think too many people put the correlation like the economy is obviously loose because stocks are high. Like I think that's a correlation people take too far. You know what I mean? But as SVB is actually, I never give the Fed credit, but I think they handled that pretty quickly and pretty well. I mean, it's hard to debate that they didn't come in. They did exactly what they were supposed to do. It was pretty amazing response. You know?
It was a what my point is it was a disproportional response. Like,
well, I think that was by design, you know, like just come out like we're gonna do it, and then
but when you make it, and so that's what's going to be required to offset any AI bump, is a disproportionate response. Are we in a world in which a disproportionate response can occur? Like,
they can't even agree what inflation is anymore. So I doubt it.
We have a much different Fed now too. It's much more divided. It would be interesting to see if they could all get on board.
And can the fiscal do it? Like, SVB, you had the benefit that it was a bank crisis that the Fed had to participate in.
Yeah.
If it requires a fiscal response, are we set up to have a fiscal response?
What are we responding to? You're saying like they can't function.
Let's say the capital market. Let's say the capital market. Let's just put it out there. So they need $1 trillion, and the capital markets over in next year, and 800 billion the year after, and 800 billion, and for years to come, we're going to need the capital markets open and operating, and they close for 6 months, and so all that capex, that war funds, gets delayed. Who cares if it's delayed? Honestly. If 6 months from now, if you were told, forget stock markets, but for the global economy, if you were told that everybody who's working on AI had to put their pens down for 6 months and they could pick them up 6 months later, would that matter? No, of course not. Of course it wouldn't matter. We're being told that we're at war and this has to happen now. And so my question is, what if the capital markets closed and it couldn't happen now? Would there be a fiscal response? So we still have to fund it, and I think it's been nice that there's been this war chest of equity investments due to the CHIPS Act and some other modest legislation regarding quantum, et cetera, that allows Trump to take stakes in public companies. And that is a fiscal response, but it's tiny. They bought $1 billion of IBM stock. Tiny. It served a message, don't get me wrong. But I'm talking about a 500 billion gap between what's needed.
Probably not. They probably wouldn't be able to. They probably have to step back, and we'd have to deal with the consequences of that. It depends if a war is actually believed. Like and obviously no one's putting me in front of the Fed, but I would laugh at people when they were like, the bond market's going to make me do something. I'd be like, go ahead. Like go higher. If we need higher yields, I will suffer the consequences. If we need to do that, I will suffer the consequences because we need to do it. So the government's going to try to signal, just like they signaled at the COVID lows. They're like, we're going to buy corporate debt. Like it's not like just the thought that they would do it was enough. And eventually the thought of just doing it is not going to be enough.
So you
and
think,
then you're put into the position where you have to be like, you have to come and do it. And how are they going to do it?
right. So without a financial institution going bankrupt, of course they could. Situational awareness is irrelevant as a contagion, but hey, listen, Jane Street lost $15 billion of their $40 billion of profits last month. Okay, maybe there is a financial system blow up, but assuming there's not, and all you have happen is corporate bond spreads blow out 100 basis points because the capital markets closes. Are they going to announce corporate bond buying?
I don't think so. I wouldn't. I wouldn't, but maybe they would. Who knows? But I don't think so. And certainly, I mean, that could put us into we can quickly talk about the politics of it. It's like, is there going to be on the other side of the equation? It's more likely that we're deadlocked as far as like who is in control of the actual government. As far as trading goes, it's a little difficult because the predictions are so far in the Democrats' favor that it's only a surprise the other way. But
I look at the politics just in terms of what it's at. Like, can you get I don't think there's even a tail outcome where Republicans win the House and increase their Senate seats.
Yeah.
Like, I don't think that's in the tail outcome. Maybe it happens. If so, then you'd expect potential for a policy response. If they ran the government, you'd expect other ability, but they don't. So I think the best we can get is what we have, which is the only thing that can be done from a budgetary standpoint is reconciliation. And that has significant limits. Unless, of course, and you get the best thing about the government is in a crisis, it's a uniparty. In a true crisis, I don't care what the count of senates are, everything's going to get passed. TARP got passed, right? You take a real crisis, it doesn't matter what the constituents are. I'm just talking about I'm just talking about a bump. Again, we started this by saying how people are prone to extrapolate doom and utopia, and I think that's what people do. But I'm just talking about a bump. I'm talking about capital markets closed for 6 months. It changes the dynamic radically.
Well, I mean, everything is crashing. Like it's
crashing. I mean, 100.
It depends what you think a crash is. I mean, 20%, 30%, yeah, pretty quick.
Yeah, I guess. I mean, because people will say it's over the capital market. We will never buy another chip again.
I think it would be pretty quick. I think you would get a pretty big correction. I'm not saying you shouldn't buy it, but I think you would get a hell of a correction if that happened.
Yeah,
maybe not.
Do you remember? Didn't they vote against the TARP originally? It was like an afternoon vote, and the stock market had like 30 minutes to go, and just dumped them. But they
imagine now with zero DTEs and levered ETF, what that would have looked like. And I think that looked like a 5 or 10% move.
Yeah. Or even like a 2018, was it 18? I always mix up the year because it was December, but the Christmas Eve.
18, yeah.
Where 18, where it just like, where it was a half day and everything's just tanking and we're far from neutral. And then the next day they're like, whoa, guys, we were just kidding. Like,
yeah.
Merry Christmas. Merry Christmas.
Make your religion fast in those situations.
Yeah. Interesting. So again, I think so we've got this AI's gonna be great, or at least, and everybody expects it's gonna be great, and all the earnings are priced as if it's gonna be great. What does it mean to the rest of the economy? You know my pie idea, which is the GDP of the country can only grow so much, and that's the entire pie from which earnings can be generated, and wages and labor and everything else has to all eat from that pie. And even and I'm placing rosy projections on nominal GDP, 5, 6%. There's not enough pie. If these guys win and get all the things they have, I don't see how the real economy, like, imagine 10% of your budget goes from 0% of your budget to 10% of your budget goes to buying tokens. What does that mean to consumers? What does that mean? And how are the consumers doing generally? And what does it mean toward businesses that are not beneficiaries of all that spending, but are payers of all that spending? You guys have any thoughts on that?
Go ahead, Jimmy.
I'm just wondering, are we starting to see some effects on the economy right now? Like this week, where we've gotten two weak labor reports in a row, weak retail sales on Friday. I don't know, how will it show up? Will it suffocate, like you said, other parts of the economy, and will that start showing up in the macro, and maybe that's how we can read it.
But you're not seeing it in the things you like to talk about regarding like tech light indices,
Yeah.
like Dow and equal weight and all those sort of things. I don't know what Russell's been doing lately. I try not to pay much attention to Russell, but
Garbage index.
you look at some of these other major sectors, banks doing great.
Yeah.
You look at most of the major sectors, they're all up.
Yeah.
It's like everybody thinks they're going to get a piece of the pie. And yet,
I guess me personally, I really try. There is like that drunken Miller type idea, like, hey, you'll get, if you look at the earnings, you look at like you'll get a better projection of the economy than if you look at government data, let's say. But I really think the price itself is not really a fantastic indicator of what's actually happening. You know what I mean? Like, just because people buy a stock, it doesn't instantaneously validate the growth of that thing. I know that's the point, but like,
well, I mean, the question is, okay, if that's the point, are selling the non-AI stocks to trade and buying the AI stocks, like, or is it not playing that winner? How do the winner losers look up to you guys?
well, as a stock trader, I can
They
tell you.
all look elevated.
Yeah. Well, as a stock trader, I can tell you that it's never been more scary to own certain companies, because tomorrow it could be down 30%. Like you could come in tomorrow and it's just like we own Zscaler, and we were up like 40%, and within maybe 10 minutes, like we lost all those trades. We broke even on the trade. So it's like,
how about the real economy stocks though, like healthcare?
Well, I like healthcare.
All the things consumers spend money on, that they presume. Maybe I'm crazy, but I don't think the people that are not producing chips, producing compute, creating models, all the people that are making earnings based on other activities depend on the consumer. And they themselves, those same companies, are saying, my competitor is buying a bunch of tokens to beat me. I got to start buying some tokens. Are these guys just, I guess maybe that's the question, which is, can these companies and consumers who are trying to stay competitive in the workforce and may buy tokens, how are they going to fund the rest of their spending? Doesn't it have to come down?
I think there is definite economic harm in the current situation. I don't think that. I think the vast majority of the growth is in the AI sector, and that everyone else is suffering because of it. Like, so I agree with that. But I think that just the general lift in prices is lifting all the stocks up. So there is some masking of that pressure if you just look at the price of the stock indices. Like Jimmy said, you look at retail sales, they're down. You look at the jobs report, it's down. And we're saying things like,
Hey,
oh, well,
inflation is down. Like they're making
exactly.
sense
Yeah.
out.
I personally believe that the Fed is tighter than people think. I personally believe that wages are going down. I personally believe that the employee, which was in control of the debate here for a couple years ago, like my wife was getting raises all the time. Those aren't coming as much anymore. You know what I mean?
No.
Like that type of, there is pressure on the underlying economy. It's just, will it be saved by the AI productivity? And it's a question that I don't think we can really answer. But if I had to guess, I would say no. Right. But for now, I don't think that the stock
And
market
so that's
really
why
gives
we both like real rates quite a bit here. Is that the reason for liking real rates?
Yes, there's two reasons. One, not everything has to be like I had an old dietitian. He always said, like, if you change your diet, it's relative to what? Like, if you eat McDonald's every day and then you switch to eating hamburgers at home, is that a good diet for a professional athlete? No. Is it better than what you were doing? Yes. So it's relative to what? You can take 3% real yields in a portfolio and do amazing things and not give a crap about the price of the bond for 30 years. You can have that built-in protection. So I like real rates in that sense. But timing it will be a little more difficult. But I 100% think that this 3% real yields are way too high.
Where you guys stand on the front end? What are you seeing on the front end? Because if this is true and we get a slowdown, either led by AI slowing its investment because it can't raise the money, or ongoing weakness in labor and the consumer, twos are pricing in hikes.
Well, Jimmy can talk to the technicals real quick, but I would just say when it comes to the actual thing, I think the 2-year and the SOFR things get related too much, but I think that we're going to push out the hikes into 2027. So I think that general move is slow. It's slowly happening. And I believe, you're going to get no hikes in the price. I don't know if it's going to happen or not. That has to do with Iran, and oil prices. But if we were to stay where we are now, I think they push that out, and therefore there's a little room in the front of the curve to go higher. But in general, I would prefer the duration in the long term, just because I think yields are attractive and real rates are attractive. But technically, Jimmy could answer that question a lot better.
Technically, obviously, there's been a big sea change really in the front of the curve, and the spreads, going absolutely ballistic this week. And Andy, you brought up a good point weeks ago that, and this has been misread, I think, by a lot of pundits, is like, I think there is an inclination by both Warsh and Bessett to let the long end breathe a little bit. He absolutely, I don't think he can raise rates. I think he is under somewhat of a mandate early by the Trump administration not to touch rates. But his response, he can let the long end then go and kind of regulate and squash inflation with long rates. And basically, and have cover with Trump by saying, hey, listen, I can't not do nothing on the front end and then in jawbone the back end as well. Like, I'll lose, that's the credibility part, and I'll lose the back end. But he can let it dribble, like he's doing. I think the Fed, I think Warsh, that's by design. I think he's going to let the long end breathe. But I think the front end, I think that's a dip buy. Any dips that we get would be a buy. I don't think he's going to touch rates, period, unless we get a spike in energy, a further spike in energy. If the Iran situation spins out of control again and crude goes back up into 90 or 100, then yeah, that might force him, even though, yes, it's probably a silly reason to go on rates, but the market might force him to stabilize, But other than that, I just don't think he's touching rates. I think the next move will be an ease, not a hike.
So we got hikes priced in.
It's a
I
fade.
get the dip, I get the dip buy, but gun to your head, you'd go long.
Yeah, yeah. SOFR is already like 25, 30 basis points off their low. So, I don't want to do them here. I'd
Yeah.
like but the
Gun
next
to your
dip,
head, you'd rather
I think,
punt.
I mean, is it Bank of America that's calling for 3 hikes in 26?
Listen, there are dozens and dozens of frustrated, and I'm one of them, by the way, frustrated. Get fucking kill inflation already. I get it. And doing nothing is not killing inflation. So I get the sentiment, but
But can't he kind of kill inflation by letting the curve steepen
I think
But
so.
what inflation, like when we say inflation, I know I'm kind of on an island here, but like the core metrics are fading, like they are down. And when we talk, is most of the inflation is supply driven. Like it's if you want to talk about the general effect on people, yeah, 3% is high, 2.5% is high, but
I think the
but
issue is,
relative, I don't think that raising the short rate is going to change any of that. I think it will. I think it will hurt it would hurt the who's doing well in this. People with money, people who have money are doing well in the higher interest rate world. People without money are suffering. So I'm not really sure that you're going to get the feed through mechanism is what it used to be.
yeah, I
But
mean, I agree with you in many ways. One, in terms of the path of inflation, it's coming down. It's slowing. It is what it is. The caveat to that is we've seen this play a few times in this post massive inflation 2 years, 21, 22. We've seen it's gone in one direction. But it's gone in one direction, but we've seen the same thing play through multiple times along that way, which is as soon as it's looking good, they ease.
yeah,
yeah.
And when they do, you get your bounce. You get your demand driven bounce. Now, you could say, no, what you get is a tariff, or what you get.
yeah, that's what I would say. I would say you get a moron putting tariffs on penguins, and then you get another one starting a war. Like I would say
And,
those
and
two
I
things.
get you. And I get you. I get you. But the fact is, the inflation stays high. And I got to tell you, as much as I see, again, this is where you get lost in the data. People are paying the price. People are finding a way to consume. Now, I am taking a bit more, I'm probably extrapolating more than I normally do and probably shouldn't, but I am extrapolating some of this retail sales thing because it all makes sense to me in the concept of people are spending on stuff that labor isn't in charge anymore, and people are struggling a little bit more and having to just save a little bit more. But the demand keeps coming through. People are paying the price. And when the supply happens and oil comes, a gallon of gas goes from $5 to $4, people say, okay, I'm going to spend the extra dollar on something I was waiting for. And so there's this I just think this underlying, and so I guess my point is, we see that in the data. It's coming down. We've seen it bounce for maybe demand reasons, maybe supply reasons over the course of, and certainly the policymakers, the moment they see weak numbers, I mean, we've cut 150 basis points already, right? It's not like we haven't responded to the easing of the falling inflation. We have. And yet the labor market says mostly full employment. So the policymakers and SVB was an overreaction. You pick it. They are ease. They are not in tight mode. And so you look at that and you say, it's going to be tough to get it to target, right? And so the question is, to kill inflation, do you actually have to get it below target?
I think they can get it below target.
You definitely have to. Like people are just gonna. Inflation is a crazy thing. It is self-fulfilling. If you think inflation is going to stay high, you're consuming today. instead of waiting to consume. You're buying your 3-year-old a bike and you're buying them their 6-year-old bike at the same time. And that's the way inflation gets in people's minds. And I don't think that's broken. I think that's it may come down, but I think it needs to be killed. So the question then becomes, how do you kill it? And I agree with you completely. 50 basis points of rate cut hikes isn't going to do a damn thing. 200, 300 maybe, but that's not in the fucking cards. No one's going to fucking do that.
I tell you,
so now you have to say what can cause it to drift? Asset prices, bond market yields.
One chart that we can keep an eye on too is the XRT, the retail sector chart. That it tried to break out above 90 early in the month and failed miserably, and has been kind of rolling over and looking very weak. And it's kind of the one chart out there that stuck out to me last week, that because I thought, wow, it's finally breaking out of this really long base and it's joining the party too. And it was a failed breakout, and it's been weak since. That could be one of those early smoke signals.
I haven't looked at that ETF in forever.
It's a dog. I mean, it's traded sideways for years, and I thought I was like, oh wow, here we go. It's finally breaking out, and it returned. It failed and returned back into range, and it's just looking like shit again, which is kind of that could be like one of these early signs that the consumer might be getting stretched and rolling over.
I was looking at I was thinking, geez, does this thing hold Amazon? And it doesn't. Biggest holding is Marine
real.
Marine Max and Abercrombie are the biggest holdings.
The real.
Yeah, I guess those stocks will get nailed.
I just bought something off the real.
Really?
Yeah, a used pocketbook for my wife. They have like Louis Vuitton stuff and everything on there. You get it for a fraction of the price.
That's an interesting thing. So how's that thing been doing? You say it broke out and failed?
Yeah, I mean, it's been trading, basically like 80 to 90 for, a year, and it broke. It looked like it was breaking out in first week of the month, and it just lost all momentum and turned around and started, and then. So, it's just all these little things are adding up. Employment's starting to roll over, retail sales was bad, XRT starting to roll over. I don't know, maybe it's nothing, but it's just one of all the other charts, look pretty solid. Even the shitty SaaS names and stuff, they bounced, come back. Oracle had a nice bounce. One of the ones that did dip, and it might be more technical than anything, was Google last week. And I wrote about a little bit about it, saying Google might have been a victim of its own success. The bounce was so hard out of the July lows that it didn't leave any support, and maybe we're just falling back down and backfilling some of that air. I don't know, but that was one that was a chart that stuck out to me. That could be a buy though. That 335 area got trend support, got gap support down there. That could just be a terrific buy.
What is that? Obviously, we don't know what's going to happen in the future, but we can build a scenario, right? So my scenario today is like Google at 26 times forward is expensive, right? So a lot of these things are expensive, where like an Adobe is like 10, there are stocks to be had, and I will pick at those until I see that turn in earnings. At that point, I'm going to buckle up. You know what I mean? That's what I'm waiting for. So it's just how do we time that, and what scenario are we looking for in order for that to be confirmed? You know what I mean? And that's my plan. My plan now is to ride the wave, to let it go up.
I'm going to say the one thing that made me nervous this week. Most things didn't make me nervous this week. It was fine. Nvidia announced a $250 billion credit support mechanism for OpenAI. The market hated it. Now, Nvidia stock's up, of course, since then, because the entire market ripped. But when they announced it, the market hated it. this weekend or after the close, they announced cutting that credit guarantee in half. I thought that was something. That was another canary for me, like Jimmy's XRT. It's like, and the whole $500 billion CDO credit AI CDO, it just reeks of desperation to me. And they should. There's $1 trillion of financing needs. So I'm I don't know whether it's Nvidia's earnings, whether it's Jackson Hole, whether it's the ongoing issuance from corporates, or whether it's the OpenAI, the Anthropic IPO. I like to put up that who's next thing, that who's next poster. It just feels to me like there's a fucking headwind, and Vol's cheap.
Vol's
Yeah, fall is
stupid
cheap,
cheap.
and also like if you're these companies,
And
if
bond
you
vol is pretty cheap-ish.
if you're
Like,
these
can't
companies,
you
it's
buy some bond puts and buy some stock puts and be, for 4 months, 3 months, and say, take me through the election, and
Yeah.
it seems to me like that's the trade. I'm very timid right now because I'm not making any money. My beta's doing fine, but that's fucking boring. I just look at this and say, man, spend some premium, maybe Nov Dece on both bonds and stocks, and how bad can that be?
I mean
That's the
it's
way I'm,
probably
the way
it's
and balls are cheap, and
Yeah.
that's the way I'm leaning right now.
probably a good idea.
Yeah.
It's just I think the rest of the market doesn't operate like that. I think it looks at the earnings this season as a whole as being very good, and they're on the beach and they see the storm clouds over there, but they're over there. So like there's no reason, like you could leave the beach 10 hours early and just ruin your day, or you could just stay there and hope it doesn't
And
come
by the way,
quicker.
like I'm not talking about doing it tomorrow. I'm saying like next week is going to be slow as fuck. There's no news. There's nothing except expiration, which might unlock vol a little bit. So maybe you miss a little bit if vol does get unloosed. But then you got Nvidia and Jackson Hole, and then you have a gap for typically. Listen, September's crazy. It just is. You got a gap between Labor Day or the day after Jackson Hole until mid-October.
Yeah. I just think that the catalyst will be pretty obvious to see, so then you can kind of pull the trigger. You know what I
Yeah.
mean? I don't think it's going to get away from us anytime soon.
You know
but
what's-
It's certainly not going to get away. I agree with you on the short term. It's not going to get away with us next week, and maybe probably not the week after. I'm itching though.
I'm
I'll tell you what,
shocked.
I'm telling you the way I'm leaning.
There's things out there like the SEP-OX spread, which in the VIX curve, trading up almost to 170. That's fat. With 6 weeks to go. I mean, I think it's over 6 weeks to go. And it takes you it gives you protection
It gives you
all of
the
September.
election.
And, you've seen markets come back after, is it the Labor Day weekend, and then just with rancor, it seems like September.
Problem I have with OCT is reference to options that it settles on options that expire after the election.
Mhm.
I don't know. I haven't looked at election midterms, or I assume it is pretty meaningful in non-midterms, but whether that OCT just stays bid.
Yeah.
But what is the market pricing for that? I mean, because the pricing metrics have to be somewhat of a Democrat, like takeover at this point. Like whether you agree with that or not, but like the shocker, really, the biggest tale is the Republicans do better than expected.
But again, if they do better, how much does it help? Like they have to
Probably
do a
not.
lot
Yeah,
better.
yeah. So it's like, what is the election? What direction is it going where it's bad for asset prices? Like, I guess.
My view, I'll be blunt. My view is this election doesn't matter worth a damn.
Yeah.
Yeah.
Feels that way.
So, but that said, I'm wondering whether OCT is the place. Maybe Nov, and you get a little bit more juice. Have you looked at the double spread?
You mean SEPNOV?
Yeah.
Where are we? we're about 230 on that one. That's pretty fat too, man. This curve is steep, like stupid steep.
So you get, I think on the vol side, listen, I want to buy deltas as well, but on the vol side, I think we look at outright sept after the roll.
Okay. Yep.
Because it's going to be a slow.
So verse nothing, just you just mean long.
For the time being, and then leg into it perhaps.
Okay. Sounds good.
Anyway, I thought we got in the weeds at the end, but hopefully the viewers enjoy that. Again, I think we've got these big things. AI, lots of optimism, well-deserved optimism, and just a massive headwind of financing needs.
And I guess the last thing I'll say about that is I personally think it's irresponsible for a company not to fund itself at these prices, like a Google and stuff. Like you're not a fiduciary, doing a fiduciary.
What do you think about Amazon? Amazon and Microsoft have been quiet. Microsoft's still buying shares back.
That's what I'm saying. Like I'm saying, they got to come. Like you got to get it, but you got to at least try to get to the front of the line. You got to do it before.
I think that was the brilliance of Google to do that ahead of SpaceX.
I agree, and I'm really surprised that they're not. So it's like, at some point, people are going to say like, "Oh, see it slipping," and then these things are going to hit. They're going to hit and hit and hit, and so like that's something to watch out for.
Nvidia is buying the shitload out of its stock. I don't think there's any reason why they'd ever issue, but they're levering up via circular transactions, via credit guarantees, via ownership in other companies. I wonder if they ever take advantage. Now their stock is just too fucking cheap, but you look at some of the rest of the semiconductor space, they should sell, but they're not gonna.
Anyway, I don't know about that. I think they might. They might.
Join the club because everybody else is good. So there's the people that are forced to and the people that are smart to. And if I was the latter, I'd say, look at those other guys are being forced to. Get in front of them. Anyway, Google did it. We'll see if anybody else does. All right. Thanks, guys. This was good. We will talk soon.
Have a great weekend.